Hello, everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Federal Reserve's interest rate decision and the potential trading opportunities that will come about as a result. My name is Sasha, and I'm a financial analyst from the research department at ForeTrade. I'm really pleased that more people are watching our webinars. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, we'd like to present our new offer that is exclusive to those watching this webinar. To use this special offer, a code will appear on your screen during the webinar, which I will repeat at the end, that you can use to take advantage of our special offer. Be aware that this offer will expire in 24 hours, and that this new offer applies to all of you, not just second-time depositors. If you make a deposit within the next 24 hours, you will receive a balance bonus. If you deposit €1,000, you will receive a 2% balance bonus. Deposit €2,500, you'll receive a 4% balance bonus. Deposit $5,000 and receive a 5% balance bonus. Deposit from $5,000 to $15,000 and your overnight interest rate will be covered for 1 month. Deposit $15,000 to $25,000 and your overnight interest rate will be covered for 2 months. Deposit $25,000 or more and your interest rate will be covered for 3 months. You're free to use this however you choose. And now to market opportunities. If you don't know, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's solely your decision whether you trade on market opportunities or not. Here is an example of a market opportunity published recently. Here you can see the fundamental analysis on what's going on with the British pound and the US dollar currency pair. As you can see, this is an uptrend opportunity over a weekly period. Since our analysis suggests the pound would grow in value against the dollar. Over on the right, you can see some geopolitical events. On the left-hand side, you can see some geopolitical events and fundamental analysis that can influence the British pound or US dollar currency pair. For example, this part stating that UK trade data is positive and concern over US tax reform is important to note. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.3080 that you can see on the left-hand side of the screen here, which is encircled, this shows the right moment in our estimation for opening a trading position. You can see below the trend direction and the time period. It's also important that you know how to use a stop loss and take profit options. You have support and resistance levels on the bottom of on the bottom left-hand side of the screen. At these points, you can put a stop loss and take profit. And on the right-hand side of the screen, you have calculations. If you close the position using take profit, you can expect these kind of profits at these resistance levels. If the price is going against you, then you can potentially have a loss of this amount at the support levels. Finally, profit and loss calculations are based on a one-lot trading volume. As we all know, the Federal Reserve is the central banking system of the United States that implements monetary policy. The current chair of the FOMC and the Fed is Jerome Powell, who replaced Janet Yellen when her mandate ended in February 2018. Most analysts agree that Powell will continue Yellen's monetary policy, although he will likely push to relax regulations for financial institutions. The Federal Open Market Committee, FOMC, is crucial since it's the body that makes important decisions on monetary policy by raising or lowering its target for the federal funds rate, the interest rate for overnight borrowing between banks that has a great impact on the price of the dollar. The Federal Reserve's mandate is a dual one: to keep inflation below or close to 2% and to create jobs. And it's doing it with monetary policy, the setting of interest rates. You can see on this table how the Fed has kept interest rates historically low as monetary medicine to kickstart the economy following the financial crisis. At the end of the graph, you can see the current interest rate of 1.5%. Jobs are also considered an important factor when deciding to hike rates or not. So the previous Federal Open Market Committee meeting took place on January the 31st. The interest rate remained unchanged at 1.5% as expected. The last interest rate hike of 0.25% was announced in December, in line with analysts' expectations. January's decision took into account current economic conditions and outlook for economic activity, which is positive, with the exception of slightly below target inflation. The decision to increase interest rates unchanged. The decision to increase interest rates was unanimous, and members noted improvement in the jobs market and a small rise in inflation. Importantly, the committee expressed a general belief that inflation will continue to rise. The dual target of maximum employment and inflation of 2% remains. The Fed also stated that current plans were to raise rates 3 times by the end of this year. The markets had already priced in the Fed's expected interest rate rise and the dovish tone of the Fed. On January the 31st, the day of the release, the dollar index grew 0.2% against a basket of other currencies, as you can see on this graph. The euro dollar, on the other hand, declined upon the release and within 24 hours was down 0.70%. We can see here the core PCE and core PCI. One of the main factors that's been causing the FOMC to be cautious to raise rates has been the rate of inflation that's been below the 2% target. As you can see on the chart, personal consumption expenditures, or PCE, which measures prices paid by consumers for goods and services, remains under 2% and has been the main problem in keeping the inflation rate off target. But although the other main indicator, Core Consumer Price Index, that's CPI, is still under 2% target at 1.8%, the Fed believes a small interest rate hike would not bring inflation down. So, what can we expect at the meeting? The US Central Bank is widely expected to increase interest rates from the current level of 1.5% to 1.75% when it meets on March the 21st. Analysts and traders are so confident about this that the current target rate probability from CME Group indicates an 88.8% chance that interest rates will increase by 0.25%. Bloomberg's estimates of a rate increase are even higher at 99%. Investors will also be keen to see any Fed plans to tighten monetary policy further in 2018. Statements like that might set the tone for global markets in 2018. Despite weak inflation and improved wage growth, the Fed still thinks it's appropriate to hike rates only at a very slow pace, as Chair Powell believes that a tighter labor market will nudge up wage growth and inflation. Thus far, no major changes in the interpretation of the labor market and its impact on Fed policy under Powell has been made, and he said that he thinks it's appropriate to continue the gradual hiking cycle. However, uncertainties remain on how he will potentially react if there's an adverse shock to the economy. As I've already stated, traders expect a small hike this month. This month's Fed interest rate decision comes amid a weakening dollar that has only recently stabilized somewhat. Additionally, US Treasury Secretary Mnuchin recently stated at Davos that a weaker dollar is good for the US economy. However, this puts him at odds with the new senior White House economic advisor, who offered trading advice stating, "I would buy King dollar and would sell gold." You should still bear in mind that since interest rates remain at very low levels, economic growth and borrowing is being encouraged, which usually helps stock prices to rise. However, since President Trump announced tariffs on steel and aluminium, investors are nervous of a trade war, and historically US trade barriers have tended to weaken the greenback, as was the case when Presidents Clinton and Obama introduced tariffs. In case you missed the promo code during the presentation, this is your last opportunity to take advantage of our special offer, which will last for 24 hours. The promo code is FED1X. Again, we feel that it's a great option to use our special offer either on this event or to potentially trade on a market opportunity. But the choice is yours. Of course, we at ForeTrade will be following developments related to the Fed's decision for what we expect will be a very busy week's trading. Please get in touch with your senior account manager for any further information. Until next time, goodbye, and please join us at ForeTrade again soon.